us, and I can start talking while I try to stream it on Facebook Live.
Hey, Vivek, how are you?
Hey, Jonathan, I'm doing fine. Hey, everyone, Henry, Patty, and
Hi,
James.
Vivek.
Hey, Vivek.
Okay.
How's the day going, Jonathan?
It's good. I mean, it's over. It's 9 o'clock here. I'm just put the kids to bed, and here I am. So,
That's awesome.
Hey, Chuck.
Oh, he made it. I just texted him to
Hey,
link again,
Chuck.
so.
Is that you guys calling me?
Awesome. Hey, Chuck. Yeah, Chuck is from Tampa, so he's in the same time zone as you.
yeah. Hey, Chuck, how are you? Nice to see you
Hey,
in
Jonathan.
person.
Yeah, I know. I've talked to you several times by computer. Nice
Yeah.
to meet you.
You too.
All right, are we ready to get started?
Let's start right at, give 2 more minutes. I'm
Okay.
trying to set up the Facebook title and live, and then we'll be ready. We'll give another few minutes for our audience to join.
Yep, they're beginning to pour in.
So if all the audience could share where you're from, that'd be a good place to begin. We'll start at 6:03 sharp. Just give a few minutes for people to trickle in. Nashville,
problem.
Tennessee.
Hey, you ever walk that bridge behind you there, Vivek? Golden Gate? You ever walked across that from one side to the other?
I've biked across it. I've never walked.
Have you biked across it?
Yeah.
Did you feel it sway at all or anything like that? Or?
No, I think it's pretty sturdy. No earthquake at that time, so.
Oh, okay.
I think we have our first New Orleans attendee, as far as I know. BH, welcome to the webinar.
Seattle, Washington. Nashville,
Awesome.
Tennessee.
It's
Awesome. Yeah.
Coast to coast. We just need someone the northeast here.
Well, that's me. I count, don't I?
Yeah.
from New York.
Only attendees.
Oh, there we go.
So-
We got someone from Newark there in Hong Kong. That's Eddie Wong. Hey, Eddie, how are you? I know Eddie.
oh, there we go. All right. Well, it is pretty sharp on the 6:03 mark.
All right, so I am actually just going to put up a real quick, just a quick promo before we go into the interview portion. So let me go ahead and share a quick screen, and we'll go into interview. So go ahead, James. You want to kick us off?
Yeah. So thank you everyone for joining us. This is, I honestly lost count. I think we're at our 9th or 10th Coast to Coast webinar. It's up there. So because we have a lot of series going on. But this is our next event for the series of interviews with the masters, where we interview experienced operators and players in the commercial real estate space and real estate space in general, to really learn from their experience and have an opportunity to ask them questions and really just have an opportunity to have a learning and sharing environment. So Jonathan, we'll be giving a brief bio on him in a bit. But a little bit about us, just in case anyone's not aware. The next slide, Henry. Here's our panelists today. Today's panelist webinar is given by the M5 Capital team. All of us are on the webinar today, which is great. And we are definitely coast to coast, east, west, northwest. So we don't have quite all 4 corners covered, but everyone on the panel is on the slide today. And the next slide, and just here's our contact information. And I do want to highlight our Facebook group. We've been posting a lot of great content multiple times a week, and there's a lot of great analysis that we're putting on those articles. So be sure to check that out. We just click on the join button on the Facebook group, and I or one of the other moderators will grant you access. So feel free to engage and participate, ask questions there as you may hear as well.
I think that's the last one.
Yeah, I believe so. So
Right, let's stop share.
yeah. So, Henry, did we want to give a brief bio or introduction on Jonathan, or do you want him to handle that part?
Yeah, I think it'd be great to hear from Jonathan because
Yeah,
he has a lot to talk about.
straight from the man.
Well, as for the bio, let's see. I was I'm here. Grew up in the New York City area. I've lived in a couple places other than that: New York, London, Tokyo, Boston. I spent about 12 years altogether as a commercial litigator slash real estate lawyer here in New York and in Boston and London. And in 2011, went into real estate. I've been doing real estate ever since. I own a company here in New York called Two Bridges Asset Management, which is a syndication firm, and also run a coaching program called Multifamily Launchpad. So that's very brief. You can ask me whatever questions you like, go into more detail, but that's kind of the brief background.
Yeah,
Great.
thanks for that, Jonathan.
Sure, and you forgot your Facebook group. It's reached 10,000 members now.
That's right. So I run a Facebook group called Multifamily Investment Community, which is it's a free group. It's also a very spam-free group, and we just focus on just trying to provide people with good free advice and support, and learning the ropes of multifamily real estate investing. And we just crossed 10,000 members this week. So
Congratulations.
yeah, thank you.
Yeah, definitely growing like crazy. So, Jonathan, I always see whenever I'm on a Facebook group, I always see yours for some reason on the side of suggested groups, and it's just always there, even though I've already joined. So, I think there's a sign there. So,
yeah, that's good. Well, who knows if Facebook's algorithm is
yeah, they really want us to join. So, yeah, everyone on the webinar, be sure to check out Jonathan's Facebook group. A lot of great stuff there. So with that, we do have some questions that we've prepared in advance that Jonathan, we'd love to hear your thoughts on.
Sure.
We have a kind of a rough order here, but I'll hand it back over to Henry to kind of kick it off. Then we can kind of go around them. But then
Sure, yeah.
And then at the very end, we'll have a live Q&A from the audience as well.
Sure.
So,
I think one thing to know a little bit more about how you get started in real estate, because I think a lot of the audience here, some of us here are maybe either have already started just investing in general, or maybe starting looking at multifamily. But we're also always interested in see how you started on your journey.
Yeah, my background in this is a little bit unorthodox in a lot of different ways. I mean, I did actually come from a semi-real estate background when I was practicing law, where I was representing for the last 5 or 6 years of my legal career. I was focused on representing hotel owners in litigations with the hotel chains. And I think a lot of people don't realize this, but when you see like a Marriott or a Hyatt or whatever, they don't actually own that hotel. It's usually a private investor group that owns that hotel, and it's a third-party management arrangement with the hotel flag. And sometimes it's even split up further, where sometimes it's a third-party management company that's independent, and it's a franchise agreement with the flag. The flag is the hotel brand. And so it's similar to the way that syndication deals are set up. Oftentimes the hotel is syndicated, and then you have, you're like, just like you have a property management company for multifamily real estate syndication, you have Marriott, right? So it's a very similar structure. So I cut my teeth kind of seeing those structures from the backside when they were falling apart and they were being litigated. So I kind of learned how these deals worked from reading all the deal documents and stuff like that. But that being said, I wasn't terribly happy as a lawyer and was really looking for ways to get out, something else to do. And a lot of things sort of happened at the same time. One was that the financial crisis hit, and after about 2009, the work really slowed down at the firm. And even, in past recessions, when there was a recession, there would be a lot of litigation, so we'd get very busy. But the great financial crisis was so bad that people didn't even want to pay to sue each other. So we were was kind of sitting around with not very much to do. And during that time, I spent a lot of time thinking about like, what would I really rather be doing? And what I really would rather be doing was investing in real estate. So I spent all this time, like basically at my office, getting paid a lot of money to surf the internet and like I was looking at triplexes in like upstate New York and stuff like that. And that went on for a couple of years until 2011, when it kind of became clear to me that I was sort of reading the smoke signals, and it kind of became clear to me that they were probably going to let me go soon because they were tired of paying me to sit around doing nothing. And I started doing a lot of networking in real estate because I decided, well, I think that's the direction I'd like to go. So I was out in New York City going to like all kinds of networking events, not real estate ones, but just sort of general networking events. And every time I met somebody who was in commercial real estate, I would say, hey, let me take you out to coffee and pick your brain. And I started getting this kind of consistent message from people, because at the time I wasn't really thinking like, oh, I want to go and be a real estate investor on my own. I was thinking, oh, I want to go join some real estate investment shop, like some, private equity firm or something like that, because that's where my head was. And what I kept on getting was, well, Jonathan, look, I'm going to be honest with you. At your age, I was already 40 at the time. At your age, you have a great background and everything, but at your age, you're just going to have a hard time getting hired. Plus, there's all these guys on the street now who have been in this business for 20 years who are looking for jobs because they all just lost their jobs. So if anyone's going to get hired, it's going to be those guys, not you. And really the only way you're going to break into this field is if somebody says, hey, let's partner up. And, because I see some skill set that you have. And it's basically what happened. Like I was out there networking with a bunch of people, and I encountered this woman who was starting up a real estate investment business. I then did lose my job. And so I really was kind of had to figure out what the next thing to do was. And then after she said, well, hey, why don't we join up together? My inclination was, well, I want to kind of vet her with people that I trust because I really don't know how to even evaluate this. So I kind of trotted her around several of my very financially sophisticated friends that I trusted and said, what do you think? And after meeting with her, all of them said to me, hey, she seems like she knows what she's doing. If you decide to join up with her, I will invest with you. So I wound up having like the offers of a couple of $1 million of investment capital before I even had committed to joining up with her. So I decided like, this is probably a sign that I should try this out. So I said yes to the offer, but I didn't even really know at that time what we were getting into, because I had been thinking all along, like when I was thinking about investing in real estate, what that meant to me was like buying a brownstone in a gentrifying neighborhood in Brooklyn, because that's kind of like all people talked about around here. And she was like, oh, no, we're not doing that. We're going to go buy 100-unit deals in Louisiana and Texas and syndicate them to investors. And I was like, what? Like, you can do that? Like, you can buy 100-unit property? Like, how's that possible? And, but you could buy 100 units in Louisiana in those days for $3 million, right? So, and sure. I had like the 2 million lined up already. So we just sort of forged ahead and tried to make a go of it. To make a long story short, we wound up, even though we had the equity capital lined up and we had, she had some experience in the field and we had a credit partner. I mean, we sort of had all the pieces lined up together. We could provide proof of funds from our investors. We had everything, all the pieces in place. But it was unlike today, even with COVID going on, unlike today, it was a very, very bad lending environment. And we got into contract in a couple of deals and had the lenders back out literally the last minute over really ridiculous stuff. Stuff that when I talked to other lenders later, they were like, they just hosed you. Like they just wanted out for some reason and made something up. So we wound up going very deep, like almost to closing on a couple of deals. Lender backed out, and we were out of pocket a lot of money. And then we also decided, we probably, along the way, we had kind of discovered that we didn't see eye to eye on a number of issues. So at that point, we decided to to go our separate ways. And after that, I went out to dinner with one of those guys who had said, "Hey, I'll invest with you." And I was like, "I'm not really sure what I'm going to do now. I might have to go back to practicing law." And he said, "No, don't be so hasty. Why not we form a business together? I'll be a silent partner. You run the business." And that was how my company, Two Bridges, got started. From that point, it was about another year till I finally got a deal done. Which was in early 2014.
Well, that's awesome. I mean, I think that was one end of the cycle, and it reminds me of your contrarian thinking in economy. Like, I think last September or October, you sent out an article saying Sam Zell and Warren Buffett were piling up cash, and on the other hand, a lot of syndicators were making deals work by projecting, rosy numbers into the future. You had said that the market had reached a state of euphoria, very contrasting to what you had seen in 2011. Where do you think we are in the cycle right now, Jonathan? Meaning with the coronavirus and its side effects on the economy. Where are we in the economy right now? Because a lot of people on the call are really curious to hear what's.
Well, so I'm going to give a very unsatisfactory answer to this question, which is that it's really difficult to figure that out right now.
Sure.
I think we're in a really uncertain time, and it's first of all, it's unprecedented. We've never had anything like this before, where we just shut the economy off, like just turned the faucet off and said, "All right, nobody's doing business," and at the same time, the government just pumped trillions of dollars into the economy all at once. So we've never seen anything like this. So, if you asked me where we were in January 2020, I would have said, well, yeah, we're definitely at the euphoria stage of the cycle. And the reason I thought that was because there had been a kind of period around 2018, 2019, where people started becoming a little bit more cautious because they thought that maybe a recession was going to come. And then in 2019, everybody decided, oh, no recession's coming, and let's just pile in. And even though we had historically high prices and historically low cap rates for multifamily deals, before that, it went even higher. After kind of plateauing, there was sort of slow growth for a while, then suddenly, like, boom, it just exploded again last year, at the end of last year. And that suggested to me that, like, we're now entering the stage of the market where everyone's decided this is going up forever. There's no risk here at all. Like, it doesn't matter what we pay. And that was a very dangerous place to be in. So to then be at that state, so we're at that peak, and then the government shuts everything off, and it sent us into this, we still don't know what. And the reason I say that we don't know what is because, well, if you're looking at rent collections, everything looks great, right? But you're also in a situation where the government has given everybody all this money to pay their rent, right? And that's ending next month. It may be extended. It may not be extended. We're just in this situation of, we also don't know what the permanent casualties are yet because they're being masked by the data. So we don't really, a lot of people are saying that we're actually on the cliff of a massive wave of bankruptcies, right, from companies that fall. But none of it has happened yet. And meanwhile, the numbers look good. So it's very unusual, the situation where everyone's saying, the underlying economy has got a huge amount of risk in it right now, but rent collections are high. The stock market is going haywire. And so, like, there's so many conflicting signals that it's very difficult to figure out where we are. My gut, though, I would say that we're probably on the precipice of a correction, but how big a correction, how long it's going to last, I can't really say. I think really we're going to find this out, sort of how big and how bad, in the fall, when this stimulus money runs out. When it's extended, I don't think it's going to be extended as generously. I'm talking about the enhanced unemployment benefits, and we're going to start to see those bankruptcies coming in. And I think when that happens, we're going to have a better understanding of where we really are. But I don't think it's going to look as good as people are saying that it looks now. So that's my view.
Sure. Yeah. I think a lot of it is driven by stimulus because multifamily collections have been really amazing. But at the same time, you have to realize it's afloat by the trillions of dollars of printing, and also I think I read this article somewhere that Class C tenants are making more of unemployment than if they would actually go to work.
Yeah, and it's I mean, what we're seeing is, we've got 20 million people unemployed, and rent collections are better than they were this time last year. So something, the gap filling in those two is the stimulus money that people have gotten, right? So, and potentially maybe the fact that to the extent that people have savings, like nobody's going out and spending money on anything right now. They're not going out to eat. They're not going on vacations. They're not buying new cars. They're not doing anything. So they've got money to pay rent, and they don't want to fall further behind. There's also some evidence, but I don't think anybody really knows the answer. Well, I don't know the answer yet, but there's some evidence that payments by credit card have risen. Now that makes sense in like a contactless world where people are paying online. The unknown here is, are people paying their credit card by credit card because they can, and B, like they want the points, and then they're just paying their credit card off, or are they paying by credit card because they don't have money they have no other way to pay. We just don't know that yet. So I think a lot of unknowns right now that make it very difficult to figure out sort of where things are heading.
Yeah, there's definitely a lot of very confusing signals. I can still see that unemployment rate is still very high, despite the fact that seems to be some recovery. People are going back to work, retails are getting better, but we're still seeing a massive unemployment. So I think that somehow is going to be reflected. There's a very different reality. It looks like there's a real economy, and there's like the stock market, the asset market is completely different story.
I think like the stock market is reacting to good news, and I think it's a function of like a lot of stock market actors trying to get ahead of the guy, the next guy. So they're all jumping in trying to get ahead of that, but it's not based on like fundamentals as much as it's based on speculation that other people are going to be jumping in. It's kind of like the greater fool theory. I think what we're going to see is, because just as, the economy fell off a cliff when the government turned off the spigot. Now they turned the spigot back on, and it's going to like rise very rapidly, and it's going to look amazing, right? I mean, we're going to have, within a couple of months, we're going to hear people talking about the greatest recovery that has ever happened in the history of the world. The problem is that once we get through that's like the low-hanging fruit, right? The people who are going to go back to work just because it's okay to go back to work, right? But at some point, we're going to hit that wall where we reach the people whose businesses are gone forever, right? The ones that didn't survive. Like, those people aren't going back to work. And there are people who, work in industries that are, even if their companies are still there, they're decimated, like tourism, right? So people are not going to get on planes to the extent that they did before, or hotels for a while. I mean, even my wife is a good example of this. She works for a tourism-related company, and at first they said, we expect you all to be back in August. Now they're saying, we're not sure we're ever going to need you back. So I think there's probably a lot of that going on in certainly the tourism industries, any kind of, industries where people have to be in, close space to each other. Movie theaters, the theater, Broadway is decimated here in New York City. I think there's a lot of industries like that are not going to reopen. So we're going to hit the low hanging fruit first. We're going to have this really great looking V-shaped recovery, and that's just going to grind to a halt. So that's what I think is going to happen.
Yeah.
Jonathan, I have a question from the audience kind of on that topic as an add-on. Given that a lot of money has been earmarked for this stimulus, and we haven't yet exhausted all of it. And this is from William Hatcher. And with the government committing to, in the words of the Fed, whatever it takes, to keep these things propped up, so to speak. Do you think we'd be able to really truly value the real estate market based on fundamentals? It seems like that hasn't been the case for the equities market, but in terms of asset prices and like realistic demand, because I know a lot of the properties that we've been looking at and underwriting past few months, the rent collections have been good, occupancy has been good, but at least for us, it's kind of like we're on that precipice, as you said. We're kind of like our breath is a little held at the moment. So say for the next like 2 quarters, do you think there's going to be really any sensible, realistic, rational way to evaluating assets?
So it's going to be very hard because I don't think there's going to be any true price discovery for a while. And I think also, what's going to happen is you're going to see, deal trends. So prices of multifamily deals have held consistent, but that's really because stuff was in the pipeline before this started. Volume has dropped off a cliff, right? And so what that means is that, and the reason volume has dropped off a cliff is because this happens sort of in every downturn, where sellers continue to expect that they're going to get the peak pricing, and buyers meanwhile have changed their risk assessment, and they're not willing to pay that anymore. So you have this disconnect, and you can't have. There's no meeting of the minds on price for a while until sellers capitulate to the new reality, and then they lower their prices. The problem right now is that, sellers don't. It's a lot easier for sellers now to say, "Hey, I should get peak pricing," because they point at the numbers and look, nothing has changed. Collections are great, right? They're better than they were last year. So therefore, pay me peak pricing. And the buyer's looking at this going, well, yeah, it's great now, but what happens after I close on this deal? I can't forecast that. I have no idea where this is going. So I want you to give me, a 30% discount to build in a margin of safety so that I know that even if things tank, I'm not looking at foreclosure. And as long as that situation persists, it's going to be very difficult to have any deals get done. So, and if deals aren't getting done, nobody knows what the price of anything is, right? So, and the thing is, I've heard this, people have said to me before, oh, Jonathan, there's like $1 trillion of dry capital on the side and it's going to prop up pricing. And my answer to that is, I don't think that people who are sophisticated enough to pile up assets in anticipation of a correction are in the business of throwing money down the drain when the correction comes. And what I mean by that is they're not looking for 10% discounts off peak pricing, right? If they were piling up money in anticipation of a correction, they're looking for 20, 30% discounts. And if they believe that based on what's happening in the economy means that there's going to be a 30% drop in pricing, they're going to wait for it to happen unless something else intervenes to convince them that that's not going to happen, right? But I think right now, again, we're in this place where nobody really knows what's going on. So, all that money that's, waiting for the correction is not going to jump in because somebody offered them a 5% discount on a deal, right? It's not, because they're thinking there's still 25% left to go. And I'm not, I want you, Mr. Seller, to bear that loss. I'm not going to take that. So I don't, I don't believe in this idea that, purely because there's all this dry capital on the side means that the correction, there won't be much of a correction. I think what it means is that when the correction happens, it'll probably be fairly short-lived and a lot of capital will come pouring back into the market, and it may cause the correction to be kind of short. But I don't think it means that like prices are only going to fall 10% because, everyone's going to be overjoyed with a 10% discount off, peak pricing. I mean, 10% discount off peak pricing puts you in like 2019 pricing. So it's not, which people thought was overpriced, right? So it's not like anybody's going to get excited about that.
Right. Yeah, I think one of the things, when looking forward, are there a few signs that you're looking for? Because I know you're still looking for deals at the right price, still looking to be an operator in the multifamily business. What are some of the signs that you see? I think you said one of the anecdotal signs would be when properties start or brokers start putting prices on deals and not say to be decided by the market. But what are some of the more concrete signs that you would look at from the economy before jumping into deals?
Yeah, I mean, look, I'd be looking for like a real rise in cap rates of not just a few basis points, but I mean, want to see like a real correction in cap rates, right? Closer to, sort of where historically some of these deals have traded, right? So that's one thing. I mean, there's a lot of signs to tell you that you're in a buyer's market, right? One is, as you said, deals get priced now because brokers are looking to anchor you to a price and they don't want you to underbid. But another is when you start seeing a lot of deals, have price cuts on them, or they get their, you see a call for offers deadline, and then that blows by and you see another call for offers deadline, right? I mean, clearly they didn't get enough offers, and you'll start to see just deals languishing on the market. Now, I don't have like a, days on market metric or anything like that. It's a little more of like a feel thing. And frankly, I think in multifamily, you don't really have as much real access to that data anyway, as you do like on the MLS with single family deals. So it's really more kind of talking to brokers about what they're seeing. I mean, the good brokers are going to tell you also, like, yeah, the balance of power has shifted. Now it's now a buyer's market. You can get these deals at a discount. They'll be telling you, like, I think you can get this for, such and the whisper prices are going to be dropping. And I think there's not really like, if unemployment hits this number, it's time to buy, or if cap rates hit this number, it's time to buy. I mean, if I'm running, but I'll temper that by saying, if I'm underwriting deals and I start being able to comfortably buy stuff where, I'm hitting an 8% preferred return for my investors, in the first year without having to do anything to the deal, that's a sign, right? Because that's how, you used to be able to do deals for that. So that's, just kind of the numbers will tell you. I mean, that's where I want to be. I want to be hitting an 8% preferred return without breaking a sweat, and not having to take on a whole bunch of risk in order to, get there, right? And I don't want to, I want to be hitting like high teens IRRs with a realistic exit cap rate, not something that's massaged. So, those kinds of things.
Yeah, those are really things that you have to pay attention to, because a lot of deals get underwritten with almost no reversion to the cap rate. And I think that's projecting a rosy picture ahead. But what about the other? So go ahead, Jonathan.
Oh, no, I was going to say that's sort of like one of my favorite topics. I mean, this is getting into like really esoteric stuff, but, there's an underwriting rule of thumb that says that to be conservative, when you are calculating your exit cap rate, you should calculate it at 10 basis points higher than your going in cap rate per year of hold. And that's to account for the age of the aging of the property over the hold. So lots of people underwrite deals and they're buying at historically low cap rates and then saying, I'm going to exit, I'm going to hold it 5 years. So I'm buying a C deal at a 5 cap, which is like a crazy valuation. And I'm going to exit at a 5.5 cap. And I'm being conservative because I added 10 basis points per year. The problem is with that underwriting style is that those rules of thumb are not meant to be used at the top of the market, nor should they be used at the bottom of the market, right? They're meant to be used at the middle kind of average point in the cycle, because it's a rule of thumb. So by definition, it is meant to be used at like the midpoint of the cycle, the absolute midpoint, average time of the cycle, average deal, average time in the cycle. So
Sure.
if you're underwriting at the top of the market and you're going in at historically low cap rates, the only way to actually be conservative is to look and say, well, what do I think is the historical long-term mean cap rate for this asset? And that's what I'm going to calculate my exit at. And that's probably not going to be 5.5. That's probably, for a C deal, it's probably going to be an 8, right? And the problem is, if people do the 8, their deal doesn't make any money. And if they sell it at an 8 or refi at an 8, they're actually losing their investors' money. So of course they don't do that.
Sure.
Conversely, like if you're at the bottom of the market and you're buying a C deal at a 10 cap, you could actually underwrite realistically, or at least you should have it in one of your scenarios, an exit at an 8 cap, because you're going to have cap rate compression going up the cycle, right? So you could have one of your scenarios saying, well, we're going to do the exit at a 10.5 cap to account for the age of the property, but we're also going to scenario plan for exiting at an 8 because we know we're going to have cap rate compression, right? So so that mechanicalistic, 10 basis points per year, it's only conservative if you buy at the midpoint of the cycle, right? So, or lower, right? So, but I see a lot of people doing that and projecting very healthy IRRs at the top of the market, because if the exit cap, if all they have to do is change the exit cap to something more conservative, it doesn't even have to be reversion, it doesn't even have to be to the mean. It can be something like halfway between where they plan their exit and the mean, and they're losing money already. And I've seen deals like that. So that's, this is one of my pet peeves. So sorry for going on about this.
No, that's okay.
That's a great topic. Actually, I haven't heard much people saying that. And so that must mean that you've been underwriting quite conservatively and not, buying at the peak of the market. It's something we want to ask you. I know you might have sold some of your properties. I don't know which year you did, but after selling those properties, you didn't immediately pile back into the market, right? Tell us about that. Not chasing the market, so to speak, and finding the right time to sell. That must be a very interesting decision.
Well, I sold all of my holdings last year. And the reason I did that was because I was getting offers for more than I thought the properties were worth. And substantially more than I thought they were worth. And given where I thought the market was, I started to feel like there was more risk to not selling and missing out on this pricing than there was to, holding on a little bit longer and getting a little bit more, right? And being greedy. I just felt it was time to sell based on what people were willing to pay for assets that I didn't think were worth that much, right? And now I have to say, as a syndicator, your calculation might be a little bit different, because I think if I had just owned these assets, then I might have thought, well, I just hold them forever, right, and not sell them now. Certainly would be really hard to do a 1031 at the top of the market, so I might just have held them. But since I was doing syndications and had investor money, I felt like I couldn't, if I missed the moment to sell, like what would I say to my investors, right? Like how could I go and face them and say, I had a chance to sell at the top and I didn't, and I blew it. And now you guys are out all that money you could have made. So I felt like the risk to the downside was far greater than the risk, of missing the upside. And then in terms of, what to do then, well, I mean, look, I hadn't done a deal in a while because I thought things were overpriced. They continued to be overpriced. If COVID hadn't happened, honestly, I think they would have continued to be even more overpriced this year. I think the market has gotten out of control for a while, and it just makes it very hard for a very conservative investor like me to to feel comfortable getting into deals at those kinds of valuations. You know, and I talked to some of my syndicator friends, and you know, a lot of them have been in the same situation. They're still doing deals, but they're looking at 200, 300 deals to find one that makes sense. And lots of those guys have bigger operations than I do, so they can look at that many deals, right? And they're looking nationwide, not in a few markets like I look. So, but they're still, you know, they're not doing 10 deals a year. They're doing one deal a year because they can only find one worth doing. But I think that will change. I think that's going to change soon.
Where do you think the opportunities will be? What are you looking at? What metro or what type of asset?
Well, I'm not changing the metros I look at. I mean, I've been looking at in South Carolina and North Carolina all along. I still think that those are good markets. Yeah, I like markets with really strong population growth, and the Southeast has it. You know, I like markets that have historically not been really boom and busty. So, those Southeastern markets have tended to be a bit more steady over time. Except for Charlotte. Charlotte is really subject to like overbuilding. But other than that, like those Southeast markets have been a lot more stable over time. So I still like those markets. Like I'm not changing that. I think the long-term fundamentals are still there in terms of just overall population growth. I'm sorry, I think I missed part of your question though.
I was just also curious if you're looking at different asset class besides apartments.
Oh no, I mean I am really sticking to apartments. Although I'm very interested in distressed debt though. So I haven't really dug into distressed debt yet, but I think that there's going to be an opportunity. But I think just since my zone of expertise is multifamily, I'd be looking at the multifamily distressed debt rather than some other asset class. If I were to go outside that, I'd probably look at self-storage because I think that that's very similar in terms of the underwriting to multifamily. But yeah.
Great. I see. Yeah. Patty, do you have a question?
Oh, sorry. If I unmute myself. Okay. Well, what I was going to ask is, you know, I know that I find true stories as being a really great learning tool. And so with that in mind, Jonathan, can you share a specific multifamily horror story that you feel could be a teachable moment to our audience?
Yeah. I still have like
you have a lot.
I have PTSD from one deal I did. It was the first deal I did was a 102 unit deal in Spartanburg, South Carolina, and that deal was I don't know, it was cursed. Just everything that could have gone wrong on that deal went wrong. Some of it my fault and some of it out of my control. But so I'll sort of tell you what was my fault, and then I'll also tell you the out of my control stuff. So that deal, I think we bought it at a good price. We paid like $40 a door for it. We bought it from a flipper, so it had been rehabbed. Not a great rehab, but it was they had done work on the property, and when I bought it, the intention was just really to just hold it and run it, right? And the first mistake I made on that property was putting in the wrong management company. And I had the opportunity between a local management company that had actually run the property before and a bigger regional company that had sort of more, I thought more resources and also kind of buttered me up a lot about wanting to break into that market. They weren't really in the market. That was the problem. But wanting to break into the market, wanting to help me invest in my deals, all that sort of stuff. And as a new investor, I kind of got flattered and convinced that the bigger company would do a better job. As it turned out, though, they didn't have the resources and the connections in that market to hire the right people. So they put the wrong person on the property in the first instance. And they also then didn't really have the local connections with vendors and whatnot to get the best pricing on, say, apartment turns. So it very quickly became a situation where, occupancy started dropping really fast, and they didn't know what to do. They had this manager who didn't know how to market the property. Meanwhile, we're having like evictions, like it was the eviction of the day because they were putting the wrong people in there, and then she couldn't fill it. And then I know we're paying like ridiculous prices for turns because they didn't know the local vendors to get the good pricing. And it very quickly spiraled out of control. The other problem there was that I under-reserved on the deal because I didn't really appreciate how important it was to have a really strong reserve fund on the property for unexpected expenses. And we started getting those too. So the person I bought it from had done all this sort of exterior work and roofs and windows and that kind of stuff. But, under the ground where we had basically 40-year-old water mains and sewer pipes and stuff, all that stuff started just basically popping after I bought the property. So we had, the water main break of the month, club for a while where, it got to the point where I didn't want to answer my manager's phone. Like every time I saw my manager come up on my caller ID, I was like, oh my God, like what is it now? So, we were having to deal with, quarter after quarter, a $10,000 water main break repair. And with no money we hadn't reserved any money for that. And I didn't want to make capital calls on that. So we were paying it all out of cash flow. So we wound up, not being able to make investor distributions. And it just became, it was a nightmare. So obviously, so that was a combination of like me not reserving enough, but then stuff that happened that was beyond my control. But I should have probably known to due diligence that stuff, by looking at the pipes and stuff ahead of time. And then what happened was then we started having fires. That was the next thing. So we had a series of fires on the property, major fires that took out, we lost 10 units out of 100. So we basically lost 10% of our units to fires in like a month's time. And so that was then, setting us back again. And obviously, fortunately that was all insured, but we had to then rebuild it. And, it was just a big problem. And meanwhile, I wasn't paying any distributions to my investor. I only had one investor in that deal, but I wasn't paying any distributions to that investor. Fortunately, he was very patient, but after the second fire, he just lost patience and said, let's just get rid of this thing. I don't even care if I take a loss on it. I was able to convince him, though, not to sell and to let us kind of get back on track before we sold. And, thanks to Mr. Market and things getting crazy, we wound up making him a whole lot of money on that deal, even though he was prepared to sell it at a loss because he was just so tired of what was going on. But that was, the lessons that I learned on that property, from how to hire, hiring the right manager, being much more involved in the process of who that company puts on site, having adequate reserves, doing, due diligence on the stuff that you can't see. Just so many things that I learned from that deal. That deal was really my great teacher, I have to say. Or other things too. My underwriting was bad in that deal. Like I made assumptions like, assuming that I was going to pay the same insurance rate as the seller, assuming that I was going to pay, I didn't realize that he was skimping on staff. He had like 2 staff members on the site, and that was for 100 units. That was way too, so I wound up paying a lot more in labor than I underwrote because I didn't understand that, that his incentive was to just flip it as fast as possible, make the numbers look as good as possible. and I couldn't trust the numbers. So, the whole lesson of like write on actuals, right? Well, if I underwrote that deal on actuals, the actuals misled me, right? So you have to understand, again, like underwriting on actuals is not always the way to be conservative, right? You have to underwrite on what you know your actual costs will be, not what the seller's actual costs are, because the sellers can manipulate those costs in all kinds of ways.
Now, can I ask, did you ever figure out what the cause of these multiple fires was? I mean, one fire is bad enough, but multiple?
I never did, but I suspected that they were kitchen fires caused by tenants. So that just because of when they happened, I honestly think that tenants, turned on their stoves and then forgot them and went to work. So because it was always sort of around they were at breakfast time. So I think, but I don't know, because the fire department they said the damage is so bad we can't tell what the cause was.
No.
So I never did figure it out. But based on the fact that it happened around like 8:30 in the morning, I just always assumed that it was some kind of kitchen issue where someone, just left their stove, they forgot to turn their stove off and they headed off to work.
Thank you for sharing that.
Hey, Chuck, do you have anything to ask Jonathan? Maybe we can go to Q&A after this. Yeah.
Okay. Yeah, just real quick, Jonathan. I know we've spoke in the past and stuff, but do you take into consideration demographics and the psychographics of your tenants when you're evaluating a property? I know you talk about the Carolinas, and I know like in Florida, supposedly they're just opening up Disney World, and which will probably shut in the next week or two again, because they've got several cities. Tampa, we have to by law wear masks now, and all kinds of things are going on. So do you ever look in an area and like for medical personnel, like the healthcare people that are in an area versus say the retail type of individuals that are in an area? Because retail, the touchy-feely type jobs are going to ultimately be hit, the restaurant owners and things like that. And I know they're building huge places around here, medically related. Do you take that into consideration if ultimately like an apartment is within walking distance?
Well, yeah, I mean, I'm always looking at what the local employers are, right? So, because I don't want to be, I haven't gone to that level of, because obviously I haven't had to in terms of like where we are with COVID. But I always look at who the local employers are, who the closest employers are, because I just don't want to be in a situation where I'm overly dependent on one employer, right? And, and I do want things to be more stable. I want there to be a mix of different employment sources and as stable as one can get. And I think it also depends on sort of when you buy, how conservative you can be or how aggressive you can be. Like, one of the things that was making me concerned about owning property in South Carolina, and particularly in Spartanburg, was that it's very heavily manufacturing dependent and export dependent. And so, for instance, there's a huge BMW plant there that actually exports BMWs to Germany, right? And it's completely export led. And looking at that at the top of the market, thinking like, well, if there's a recession, what's going to happen? That plant is going to get hit in a recession. So that made me think like, this is another reason that I want to exit this deal before that happens, because I just don't want to be here for when that happens. But I think if you're buying at the bottom of the market or at a soft spot in the market where like unemployment is higher than usual, and that, well, okay, if you just have reversion to the mean, it's going to go up from here. At the top, you think, well, reversion to the mean is going to go down from here. So I don't want to bake in that high pricing. But when I talk to students about picking markets and picking submarkets, one of the things I tell them to do, and I do this myself, is, and it's not always possible, but in the best of all possible worlds, to look for anchors. And what I call an anchor is something that is really recession resistant and not going anywhere in the long term. So things like major universities, right? State capitals, logistics hubs, like where you have like major transference points, right? Where you've got these hubs where goods are coming in and then being transferred from, plane to truck or ship to truck or train to truck or whatever. Like those things take decades to build and they just don't go away, right? So stuff like that, if you're close to those things, or major healthcare hubs, right? Major healthcare hubs are good too. If you're close to those things, then your economy is going to be more resistant to a recession. Doesn't mean you're not going to get affected, but it means, like, all things considered, you're going to be better off than you are in a market that's completely dependent on, say, tourism. Like I would just avoid, heavily, like a Myrtle Beach in South Carolina or a, Las Vegas. So those are markets I'd be anxious to invest in, or markets like I always was wary about certain Texas markets because they were so heavily dependent on energy. And I'm old enough to remember, when oil prices cratered in the 1980s and you had massive unemployment in the oil patches, right? And so markets that are too heavily dependent on one thing make me nervous, unless the one thing is like something that's not going anywhere, like state government, major university, healthcare hub, stuff like that. So,
well, Jonathan, that segue, that's a perfect segue because you mentioned your students, and so would you be able to tell us a little bit about your multifamily launchpad that's coming up, and all the expert speakers you're going to be having participate in that?
Yeah, so there's a couple of things going on. So those are sort of two different things. So I run a program called Multifamily Launchpad, which is really designed to give people really high quality education without paying the freight of the gurus or the $30,000 coaching deals, right? So this is a low cost program, really high quality content. You get direct access to me, but you don't have to pay the freight of other people that out there. As part of that program, I offer members 4 times a year what I call a mastermind day, which is where I'll line up a slate of speakers for a whole day, and it's part of their membership. I do offer this to outside people who are not members for a fee if they want to come join. Because of COVID, we moved this online. It's no longer an in-person event, but we have one coming up on July 11th where I'm looking into the future of real estate. I decided to take a little break from multifamily and look at some of the other assets that are out there that they're in the news a lot. So, some that may benefit from COVID, some that may be hurt by COVID, but all of which are affected by COVID in one way or another. So we're going to be talking to experts from the hotel industry, mobile homes, office, sort of standard office, co-working. What else is there? We do have a big multifamily management company talking about what they're doing, and there's one other asset class which is escaping me at the moment. But it's going to be a full day of learning from other people outside the multifamily field about how they're being impacted and what opportunities are there. Oh, self-storage was the other one. About how they're being impacted and sort of what opportunities they're looking to obtain as a result of COVID. So that happens on July 11th.
Wonderful, thank you. Did anybody else have any questions before we move on to question and answer?
I think it's a good time to go into Q&A. I think we had one question. Henry, you want to go over the Q&A?
Yeah, so we have a question from Eddie Wong. The question is, based on your underwriting process, do you see any changes after the country started opening up? Do you see any long-term impact to Class B and C multifamily with some of the jobs not coming back at all?
Well, yeah, I mean, so the underwriting issue is that you still don't really know where things are right now. So I think you have to underwrite a lot more conservatively than the numbers are showing, right? So the numbers are showing strong collections and high occupancy, and I think you can't underwrite that way because that you'll wind up overpaying or potentially overpaying for a deal that isn't going to sustain that in the long term. Long-term impacts, I mean, I think there'll be short-term impacts to B and C properties where I think C will be hit the hardest by whatever the ultimate effect of this unemployment is, because those are the most vulnerable employees, generally speaking. But I don't think anything is safe necessarily, but B is probably your best bet because you got stronger tenants in C, you don't have the overbuilding of A, so it doesn't mean all is wonderful, but it means that you're probably a little bit more insulated from whatever's happening in that asset class. That's actually what I'm looking to target myself, is the B space. Long term, I mean, I guess it depends on what long term means, but 5 years from now, I think that these assets will be fine as long as you buy them at the right price. But the issue is not what's happening in 5 years. The issue is surviving the next 2 or 3 years, and that I think is going to be almost entirely dependent on what you pay for the property. So buy right. This is something, when I got into the business, I mean, it was people just beat on this drum all the time. You make money when you buy. You make money when you buy. Like, you don't hear to the top of the market when people are overpaying because it doesn't. They can't buy deals if they continue to say that. I think we may hear that again, in a year or two. But it is important. The price you pay makes all the difference. When I think about like the deal I described before to Patty when she asked the question about the learning experience deal. I made a lot of money on that deal because I bought it really cheap and I sold it for a lot of money. Like if I bought that property at 2019 valuations and all that same stuff happened, I think I would have been in foreclosure on that deal, right? So let's be honest. I mean, the market helped me. I bought at the right time. And that was a lesson as well. Like buying at the right time, buying at the right price makes a huge difference. And if you get that wrong, you got to execute perfectly to survive, not even to make money. So don't get over enthusiastic about the asset class, because it still matters. Like what you pay for property matters.
Absolutely. I mean, yeah, price point matters, and you overpay, and then you gotta have everything right. Anything goes wrong, and you're already underwater. Go ahead, Henry.
Yeah, we have a second question. It's from Centennial. Sorry if I say your name wrong, Kamra. And the question is, do you see a demand in suburban multifamily in big city MSAs?
Oh, so is the assumption to this question people moving out of the cities to the suburbs? I'm sort of reading that in.
Yeah, I think I would read it in that context, but feel free to clarify your questions.
I don't know. I mean, I'm not the best person to answer this question because I haven't invested in big city MSAs. I've tended to invest more in smaller cities because the cap rates were better and the competition was lower than in the big cities. I don't really know the answer to this question. I mean, there's a lot of speculation that, people want to leave the cities, and anecdotally, there's definitely some evidence for that. Mm-hmm. But I tend to think it's at the margins. I don't think it's going to be like a massive exodus like people are saying. I think that's a little sensationalist. I think there will be some. And I think the people who are going to move are mostly the people who are planning on moving anyway, who just felt like, okay, well, we've always been planning to move to the suburbs, so now is the time to do it. But I don't really foresee the cities emptying out and the suburbs getting packed. But I think there will be some at the margin, some movement.
To interject on that, we're already seeing a little bit of that in San Francisco, for instance, Silicon Valley, because people were able to survive by working from home. They don't have the need to go into the city, and therefore they don't have the need to pay high city prices. You know, you're paying in San Francisco, you're paying quite a bit of money for a one-bedroom apartment, and quite often you have people that are bundling, you know, meaning like, you know, 4 to 6 people in like a 1 or 2 bedroom apartment just to pay the rent. And so what we've been finding, or what I've been finding in my research, is that you're getting the people that are moving out of the big city because they have been able to telecommute, work from home, and they can actually, now that they're finding that they can work from anywhere, they're choosing to get out of that and go somewhere that's a lot more affordable. So that could be a trend that we'll be seeing come down the pipe.
Yeah, I mean, there's definitely, this is happening in New York also for sure, but Sam Zell did a webinar like a week or two ago that I was fortunate enough to watch, and he was asked the same question, and so I will defer to him because I trust his judgment more than my own. But you know, he was asked if, you know, if this work from home thing is going to be a long-term trend. I think he was really asked more in the context of what's going to happen to office properties. And he said, you know, and I thought this was really astute. This hadn't even occurred to me. He said, it's one thing to manage a team that's been in place already and have them work remotely. It's another thing entirely to try to build a team and bring in new people who have never worked together and have them do it all remotely. And he said, I think that this will happen again at the margins, because where people are already working together, bosses can already trust their employees. They already know they're actually doing work. They're not slacking off. But beyond that, it's hard to imagine that this is really going to be, this work from home thing is really going to be a thing. So I thought that was an interesting answer. So I'll defer to him on that.
This is a good answer. So I think we have one last question in the queue. So I know he's getting late in East Coast time as well. So it's a question from Yan from New York as well. So she asked, what are the signals you're monitoring before you jump back into the market?
We talked about this before, actually. You know,
Right.
So there's not really specific signals I'm looking for. I don't really think it works that way. It's really more the feeling I'm getting from the market, from the combination of, you know, what I'm seeing and hearing from brokers, what I'm seeing in them, you know, the offering packages they're putting together, what they're telling me the real deal is with this this complex, you know, seeing things languishing on the market, really just like understanding the shift. We're seeing the shift from seller's market to buyer's market. And that's a little bit more of like a soft analysis that requires you to be in the market and talking to people. I don't think you'll see like a metric like I said before, days on market or cap rates will tell you something, but that takes a long time to kind of work its way through the system to be reflected in the data. So it's really more about being like having your ear to the ground and talking to people and understanding that you can now buy these assets at a better price than you could. But 5% discounts is not it. So
yeah. Great point. Actually, we do have one, maybe a very last question. I think actually it's been asked for a while, been out there for a while, so I've asked that one. Have you ever purchased and or invested in any sale leaseback deals? This has come from William Hatcher.
Yeah, I haven't. So sorry, can't answer that.
All right.
Well, I think
okay.
That's the end of the questions, I think. Is that true, Henry?
Yes, I think so, yeah.
Okay, well, what I would like to do is on behalf of M5, I'd like to thank you, Jonathan, for taking the time to speak with us about the current state of things and your experience. You know, we hold it very close to heart. And I'd like to give you the opportunity to promote yourself and promote your multifamily launchpad and your July 11th event coming up.
Well, yeah, thank you. So first of all, thank you very much for having me on. I really appreciate the invitation, and it was great talking to all of you. And I hope that I was able to, help folks out there a little bit who are on their journey. In terms of multifamily launchpad, I guess the easiest thing for folks to do to get started in that is to go to multifamilylaunchpad.org, and you can download my ultimate checklist to doing your first 100-unit deal with other people's money. It's an 11-page checklist that literally walks you through every single step of the process of finding and syndicating deals, and just a good roadmap. So that will get you on my email list. If you go and join Multifamily Investment Community on Facebook, you will very quickly start getting posts about how you can sign up for the July 11th event. Also, if you're on the email list, you'll get notifications for that as well. So, and if you join the email list, if you go to multifamilylaunchpad.org, you will be invited to join the program. So you'll get, once you download the download, you'll get an invitation to, sort of see what the program is all about and join it if you want. So it's up to you, but hopefully you will interact with me further. So look forward to meeting all of you out there.
Thank you so much. Anybody? We're all good? Well, thank you again so much, Jonathan. Much appreciated. And we look forward to learning more about your Launchpad and possibly having you back on in the future.
Be happy to do it. Thanks again for the invitation.
Thanks. Have a good night, everybody.
Thank you so much,
Take
Jonathan.
care, everybody. Thanks all for attending.
Bye.
Thank you, Joe.
Talk soon.
Have a good night. Bye.